Hello and welcome to The Chart Show. I'm Victoria Scholar, and this week's three charts are the pound, Ted Baker and Tesla. After a highly uncertain vote on Monday night, Conservative lawmakers voted 211 to 148 in favour of keeping Boris Johnson as Prime Minister. Although the leader came out victorious, the triggering of the confidence vote itself, along with the fact that 41% of Tory MPs failed to back him, are both politically corrosive, leaving the Prime Minister wounded. History suggests that this could mark the beginning of the end of his time in number 10. After a very successful election victory back in 2019, Johnson has been grappling with diminishing popularity, especially since the pandemic. There's been a significant discontent among the electorate following the Partygate scandal, the cost of living crisis, and his plans to rewrite the Northern Ireland Protocol. On Monday, the threshold of 15% of Tory MPs was surpassed, with at least 54 out of 360 lawmakers writing to the chairman of the 1922 committee, Graham Brady, which triggered the vote. Let's take a look now at the chart of the pound because it came under pressure as traders digested Johnson's unconvincing confidence vote victory and as the dollar pushed higher. However, cable has been attempting to reverse course. The British currency has been suffering amid a lack of international investor confidence in the UK, both politically and economically, with criticism of Johnson's leadership expected to continue and the potential for government legislation to be blocked by members of his own party. Given the markets hate uncertainty more than anything, the fact that sterling rallied on Monday morning after the no confidence vote was triggered speaks to his lack of popularity among investors. But it is worth noting that some of the gains for cable were driven by a softer dollar, and although there was an initial spike, cable paired gains during the session as markets began to realise that firstly, Johnson may win, and secondly, the alternative may not be much better. Shares in Ted Baker traded sharply lower by more than 20% at one point on Tuesday after the retailer said its preferred acquirer is not proceeding with an offer for the company. However, it reiterated that the board received a number of other proposals and will now determine whether to push forward with any of them. Although Ted Baker did not disclose who the preferred bidder was, Sky News reported at the end of May that US-based Authentic Brands Group, which owns Juicy Couture and Reebok, was working on a bid worth more than 150 pence a share. It's no secret that the UK high street has been struggling amid the rise of e-commerce low price point competitors like Pretty Little Thing and Boohoo, leading to the collapse of one of the fashion giants, Topshop. Ted Baker already had a difficult time with another potential acquirer in the US, a private equity firm called Sycamore Partners, which issued 3 takeover proposals but eventually walked away, leading to a plunge in the share price. We've got record low consumer confidence in the UK, the cost of living crisis, the potential for a recession, and shaky equity markets, so it's understandable that Ted Baker is desperate for a buyer and explains why investors are shunning the stock. Let's take a look now at the chart because you can see that from the highs last year, the stock was trading in a descending trend line with lower lows and lower highs before finding a trough in the first quarter of this year. It then attempted to regain ground with shares enjoying some positivity towards the end of spring. However, we've seen shares gap lower this week after the preferred acquirer stepped away. It is still managing to hold above key psychological support at 100 though, but a break below might pave the way for further declines, with the next major support below that at 80, which marks the 2022 trough. Shares in Tesla fell sharply on Friday after it was reported that Elon Musk is considering a hiring freeze and cutting 10% of staff at the electric car maker. According to Reuters, Musk also said he has a super bad feeling about the state of the economy. The email went to Tesla executives late last week with the subject line, "Pause all hiring worldwide," sending shares down by more than 9% last Friday. But they closed modestly higher on Monday. This after Musk backtracked on some of his comments, tweeting over the weekend that the total headcount will increase, but salaries should be fairly flat. However, this didn't go a very long way to reverse Friday's sharp slump. Let's take a look now at the chart of Tesla, because we can see that since the peak in November, we started to see shares come under pressure with lower highs. The stock regained some ground in March before initiating a steeper descending trendline from April onwards. The stock fell to around $624 a share, the lowest level since July of last year. It looks like that level remains the important support level to watch, with a break below potentially paving the way for further losses. Meanwhile, on the upside, look for resistance at $750 as well as $800. If the stock can breach these two hurdles, that might set the stock up for either a new neutral phase or possibly even a more bullish phase.